Welcome to yet another episode of the Freedom Real Estate Podcast. Today we have a special episode, how an experienced investor analyzes a large-scale multifamily deal. And we're going to take you from the very beginning of how we analyze it all the way to how we start the stabilization process. And that includes everything from debt to raising funds to doing the due diligence. So today we're going to be looking at a deal and analyzing together with you. Now, to give you a quick overview, we are looking at a 9-unit in North Marlborough, Massachusetts. That's near Rhode Island. And the seller wants $1.4 million. It is 3 2-bedrooms, 6 one-bedroom units. Current rents are $1,000 per unit. Each unit comes with its own parking space, separate meter, gas, and electric. And there is common storage and common laundry in the basement. All right, Andrew, let's jump right into it. Step number 1 is to analyze the deal. So assuming you walk the property, you like it, one came across your desk, what are you looking at first?
So typically deals actually come across my desk before I even walk it, right? And when the deal comes across my desk, I'm looking for some quick indicators to tell me whether this makes sense, right? Mm-hmm. I have dozens and dozens of deals come across my desk, and if I even spent 5 or 10 minutes analyzing those deals, my entire day would be sucked up in underwriting. So some quick key indicators I utilize for underwriting deals and analyzing multifamily deals is the pro forma rents or the market rents on the building versus the all-in cost on the building, right? So what does that mean? So in this particular example, I think we're looking at a 9-unit in Attleboro. Is that correct?
That's correct.
I think it's 9 units in Attleboro. It's 6 one-beds, 3 2-beds, right?
Yep.
And I think around 1-beds in Attleboro, you get around $1,500 a unit.
Correct.
And then for 2-beds, probably about $1,800. These are all conservative estimates. You probably get a little more, but when you underwrite, it's important to be conservative, right? Mm-hmm. I think the full market rents on that particular building for those 9 units is around $14,400, right, on a monthly basis.
And currently, we're gaining $1,000 per door at this place.
Yep, exactly. And the seller wants $1.4 million for this deal. So what does that mean? So more or less, the market rents is a really big indicator to determine my max offer on a property, right? So I look at the max rents I can get in the building and I compare it to the all-in cost on that building, right? Mm-hmm. So they want $1.4 million for this property. Say, for example, it needs $200,000 worth of work. If that happens, that means your all-in cost in the entire building is at $1.6 million, right? Mm-hmm. And if you compare that against the monthly rent roll of $14,400, you're probably at an 8.9% rule versus 0.9% rule, when you take into account the market rents versus the all-in cost of the building, right? And what I'm actually looking for is I'm looking for I'm looking for a ratio of around 1.2 when you look at your market rents versus your all-in costs on the building, right? And when it equals a 1.2, that's an easy indicator to me that this property has the potential to produce an 8, 9, 10% cash-on-cash return, which that makes sense for my particular model.
Got it. Another thing that we'll want to look at is the price per unit. One thing that really stuck out to me at this property is the fact that they're trading at $120 to $140 per unit, where units in North Marlborough really should be around $200 per door. And this is a really good indicator that there might be some potential here.
See, and that's a big misnomer for a newer investor. That's what they would think, right? But it's not only the price per unit, it's also the price per unit comparatively to how many bedrooms it has, right? Because how many bedrooms it has is going to determine how much rent you can get for the unit. How much rent you can get for the unit is going to determine your price per unit, right? So with this particular property, a majority of the units are 1-beds.
Correct.
Right? So what does that mean? That means that the price per unit is absolutely on the lower end of the average for it to make any sense whatsoever, right? So if you're renting around, $1,500 for a 1-bed, the average is 1-bed, I'm really looking for price per unit probably at like, 110, 120 a door to substantiate, the 1,500 rent. Like I said, I'm looking for things around the 1.2, 1.3% rule, right? And that's where it would kind of land, right? So I think with this particular property, the price per unit will absolutely be on the low end for sure. So whenever I'm trying to underwrite, I always want to compare apples to apples, right? So I want to revert the mean back to what my normal business model is, right? And my normal business model is to amplify net operating income. And one of the key ways you can do that is separating utilities, right? So if I run across a building that does not have separate utilities, I can assure you it's absolutely in my business plan to separate utilities, because that will increase the bottom NOI, which ultimately will increase the value of the property far more than what it would cost to separate those utilities, right? So, when I'm analyzing these properties and it doesn't have separate utilities, I'm budgeting to separate them. In this particular case, for this Attleboro 9 unit, it has separate utilities, so that's not really an issue. I mean, obviously, I'm going to have to look at the quality of the electrical, the quality of the plumbing, the quality of the heating units, but, that would just be part of the normal underwriting process. So I think that's key, is making sure you're comparing apples to apple with your underwriting. So in all of my projections, I'm assuming that the tenant is actually covering electric and heat. And lastly, you're really going to want to look at the cap rate in the area versus the stabilized cash on cash return, right? So at North Attleboro, cap rates, you're probably talking around like a 6.5 to 7.5 rate, right? Would you agree?
Yeah, it's definitely a good area. High rents, high values for properties, and it's a pretty good cash flow market too.
Yeah, and cap rate is kind of an indication of, if you brought 100% of the cash to the deal, what sort of return would you see on that money? A 6.5 cap rate, 6.5% return, right? So that's kind of what that means, right? But the reason why it's so important is you want to take that number and compare it to your stabilized cash and cash return once the deal is complete and your business plan is complete, right? So in this particular deal, I'm underwriting for a 9 or a 10% cash on cash return, right? So ultimately, if I'm seeing the cap rate in the area be a 6.5, 7.5, and I'm underwriting based off a 9 or a 10 cash on cash return, I know for a fact I'm going to be able to suck out equity in the form of refinance or a sale, because I'm going to be able to collect that delta or that difference in that cap rate in the form of a sale, in the form of a refinance, more or less in the form of the value of the property going up.
And don't forget the value adds, because we can definitely bump up those rents. We can definitely improve the amenities.
And I mean, you bring up a really good point, and I think that kind of leads into our next point, which you're always going to want to look at the square footage of a building, right? And you're going to want to, it's going to have to make sense for the unit count, right? So I'll just give you a quick example, right? 3 unit in Worcester. You run across a 3 unit in Worcester that's 4,000 square feet. That's 3 units at 4,000 square feet. That would mean that each unit is 1,333 square feet. I can assure you, in a 1,333 square foot unit, you can find 3, most likely even 4 bedrooms, right? So if I'm running across a multi and I see the average square foot across the particular building is 1,000 square feet, but they're all 1 beds, that's an easy indication to me. I can add bedrooms, I can find square footage and find value in that building, right? So you're always going to want to look at square footage. You're always going to want to figure out the average square footage per unit, and you're going to want to compare that to the average bedroom count. And if there's a huge variance, that's an easy indication for value add.
Definitely smells like those typical Northeastern dual living room situations where nobody really uses a dining room anymore. Turn that into a bedroom.
Yeah, who needs to eat with family? Just freaking use a bedroom, right? Get it.
Exactly.
I was good.
I like it. All right. So this brings us to the second step in the deal analysis process, and that would be the offer and contract phase. Now, we've looked at the place.
Sure.
We liked it.
Yep.
We ran our numbers. Now, what are we doing to get it under contract?
So that's one of the big misnomers in large multifamily, in the large multifamily market, is a lot of times you're submitting letter of intents without actually ever seeing the property. They're blind offers, right? So a lot of times people will send me 30, 40, 50, 60 unit portfolios. I'll send them a blind letter of intent, right? And, people ask me all the time, how are you going to offer blindly?
Well, that's how you offer contingencies, right?
You offer contingencies, but you also build in fat reserves, right? And you make broad assumptions, right? So when I'm underwriting these properties and I can see the average condition across all the units might be a C condition, right? I can assure you I'm just budgeting a flat $15,000 per unit of renovation, right? I'm looking at the CapEx, I'm looking at the electrical. I'll just make broad assumptions. Okay, it looks like half the heating units are 20 plus years, half of them are 5. Maybe I'll budget for 30 to 40% of heating unit replacements, right? So I'm just making broad assumptions in the underwriting, and a lot of times those assumptions actually come in higher than what reality is, right? And if that's the case, my cash on cash return is only going to get amplified if I get that property under contract.
Very nice.
So that's kind of the key with getting your offer accepted. Once you have an LOI accepted, because LOIs, first of all, are non-binding, but second of all, they have a ton of contingencies in there that protect your money, right? You're going to want to set up a walkthrough of the property.
At this point, a lot of times you're only able to see only a couple of units during the open house, especially for these 5+ deals. You want to actually walk every single unit before you close the contract. Is that correct?
Yeah, so after the LOI stage, you're going to want to set up a property walkthrough. But like you alluded to, it's incredibly important to have a systematic approach to walking properties with a team, right? So what do I mean by that? So you're going to want to go through the property and specifically grade the tenant base on a per unit basis, as well as grade the condition on a per unit basis. And that's going to, and then at that point, allocate a dollar number to potentially getting the bad tenants out and or renovating the unit on a grade basis, right? Additionally, you got to want to prescribe roles to the people who are walking the property, right? So you got to want to have somebody take pictures of the units, take pictures of the system. You got to want to have somebody come up with a renovation plan on the spot. You got to want to have somebody, grade the interview the tenant, grade the tenant base, gain information on the property, right? So it's very important to designate roles and ensure everybody's in their lane so you can really gather all the information that you want in one foul swoop. But I think the main thing is you need to walk every single unit. You miss one unit, it could be a total gut job that could increase your budget by $40,000, right? So those are some key metrics, key things to do when setting up a walkthrough in some of these larger multifamily properties.
So let's talk about due diligence. What exactly do you want to know about the property? What are you researching?
Great question, Artem. We will tell you that back in the next Freedom Real Estate Podcast.
Oof, cliffhanger.
So due diligence is more or less you verifying what the seller says is true is actually true, right? So just think about it. What is the seller really telling you, right? He's telling you how much his taxes are. He's telling you how much his utilities are. He's telling you how much his insurance is. He's telling you how much rent he's getting. You're going to want to verify every single component of what the seller tells you. And you're not only going to want to verify that, you're going to want to project the future of what this expense will be, right? So you're going to want to call insurance companies, get a quote. Where will my insurance be for this property? It may be way higher than what the seller's paying because he was grandfathered into a rate. When these properties change hands, the city actually assesses it a new tax rate, a new tax amount, and your taxes might go up 1-2x. You never even know, right? So these are the things you got to want to vet and verify. But on top of that, you got to want to forecast for the future and ensure it actually fits in your business model. And lastly, and most importantly, you got to want to verify the legal unit count, right? These large multifamily properties, a lot of times, records get lost with the system. Units get lost. It might not actually be a legal 5 if there's 5 units in there. And if you're paying $100K a door and one of them's not a legal door, I'm sorry to tell you, but you're actually overpaying for that property by $100,000. So it's very important to do your due diligence at every step of the way to really ensure you're getting what you think you are getting.
Love it. Now, for example, for this North Marlborough property, according to the owner, we have $13,000 in taxes, $200 in landscaping, $2,000 for the repairs and the alarms, $400 for electric, trash, insurance, gas, all come out to be about $2,000 each. And he's claiming about a $30,000 annual expense or a monthly of $2,700. Now, we know for a fact insurance is going to rise on us. We know for a fact we're going to need to do way more repairs to these places because we're going to be doing unit turns. These expenses are going to rise for us just by buying this property and changing hands, correct?
You're absolutely right. So the first thing I do when I'm underwriting these properties and trying to understand is that I take the seller's information and I toss it in the trash. And what I do is I actually underwrite it based off my experience. What do I think it's going to cost to run this building, right? And then at that point, I'll compare it to the sellers. If things align, great. If there's line items on the seller's budget that aren't what I normally would expect, I would investigate it more, right?
Like you're out there getting quotes, especially.
Yep. And you're mentioning some like higher utility costs, gas bills, electric bills, like you said, utilities were separated. Why are those so expensive? Like that's something I would look into further, further investigate on like, why is that not aligning with my expectations of how the expenses should be hitting this building?
And one quick tip, when you're looking at a property, definitely call the local fire and police stations and get a sense of, do they get calls? What kind of calls do they get? Are there troubled tenants? Maybe there's a gang-related activity that you might want to know about before you buy it that the seller will never tell you.
Is there a fire violation? Fire alarm systems are very, very expensive. And, I can assure you the first people that would know about a faulty system would be the fire department.
Yep. And now we come to our third step, which is finding and securing the debt.
Yep.
Now, Andrew, how do you go about getting debt on a property?
So getting debt on the property is honestly one of the most important tasks you could do with real estate investing. And the reason for that is because it is absolutely your largest line item. I mean, otherwise, if you bring in all cash, but who the hell has that amount of cash these days, right?
I wouldn't want to put it down.
Who wants to put it down? Like, that's the whole benefit of real estate is freaking leverage, right? So, I think the key here is finding a really good debt. And the way you find really good debt is, first of all, you partner with local banks in your area, small local credit unions and banks. But not only that, you provide them a comprehensive business plan of how you plan on getting this property stabilized from beginning to end, right? So what I typically provide to these banks is a loan request package. And in this loan request package, I give a complete breakdown of where the financials are now and where they will be 12 months from now. I give financial breakdown of how the rents will proceed over a 12-month period on a month-to-month basis. Where are the comps landing on rental comps? On property comps, where will the debt service coverage ratio land once this is stabilized, and the current debt service coverage ratio? And that's a key indicator for these banks because they require typically a 1.2 debt service coverage ratio. What that means is you have to profit, 20% above the loan, right? They're not going to give you a loan if you can't pay for the loan with the income of the property. Additionally, these banks are very, very interested in your experience, right? So it's very important to show your experience in the package, or partner and have advisory type people who have the experience that can really back you up when these banks are looking up your credibility. So, all of this will create some amazing debt they can get for these properties. But it's you not only have to ask for the debt, you have to align the debt with your business plan, right? So we're buying these value add multifamily properties, and these commercial lenders, they're lending their own money a lot of times. And because they're lending their own money, you can negotiate a lot of these terms, right? So I can go to these commercial lenders and I can negotiate the interest rate. I can negotiate the amortization schedule. I can negotiate interest-only periods, construction money, right? And why this is so important is because you can align these terms with your business plan to make sure your property is going to get stabilized as quickly as possible. So, for example, I'm buying a stabilized multifamily property. If I'm buying a stabilized multifamily property, my biggest concern is cash flow, right? So if my biggest concern is cash flow, I want my monthly payment to be as low as possible. So what would that mean? That would mean that I would search for debt that has the lowest interest rate with the highest amortization schedule, right? Or if I'm buying a value add multifamily that requires a lot of construction money. In that particular case, I want the bank to give me as much construction money as possible at a 7% interest rate when I'm getting a 10% interest rate, because that's only going to amplify my returns. So for large value add multifamily, I can assure you for these banks, I'm specifically asking for construction money, and that's incredibly important for my business plan. Or, if I'm buying a deep value add multifamily and planning on refining in a year, I do not want a prepaid penalty, right? Like I'm planning on refi, I don't want to pay extra points at closing. Obviously, I'm going to negotiate that term. So finding the debt, presenting the debt, securing the debt, and negotiating the debt is really what sets you apart as a real estate investor in today's market.
Now, Andrew, let me ask you a noob question. Now, in the real estate world, we know that for small multifamilies, you get 30-year loans for residential. Mm-hmm. But in the commercial space, those are usually 5 years. Can you get a 30 or a 20-year note on a 5 to 9 unit multifamily?
So you can get a 25, 30-year amortization schedule where the interest rate is fixed for 5, 7, or 10 years. 5-year arms, 7-year arms, 10-year arms, right? 30-year debt is typically reserved for 1 to 4 unit properties, right? But what I will say is, like, who in the world actually uses debt for 30 years? Nobody. Nobody uses debt for 30 years. But when you get 30-year debt, you're paying a premium. You're actually paying more than if you got an ARM product, a 5-year, 7-year, or 10-year ARM, where you locked in the interest rate for that period, but it's still amortized at 30 years, right? So, I don't really hold much validity to 30-year debt. Additionally, the commercial loans offer so much more benefits outside of the term, outside of the fixed debt, that you'd be stupid not to use that debt, right? They can bring construction money. They can give you interest-only periods, right? They can do so much to help your business plan, that fixed debt is really a non-issue.
To be clear,
Yep.
you're getting a loan with lower payments, but
Yep.
you are refinancing in 5 to 7 years.
You're exactly correct. You're getting a loan that acts like a 30-year loan, but you're only locked into that interest rate for 5 years, 7 years, or 10 years, and it's going to reset at those certain points in the loan's life.
Got it. And now that brings us to our fourth point, which is fundraising. How do you go about fundraising, Andrew?
So the way I go about fundraising is I just try to lead with endless value as much as I can, right? So the way I do that is, I provide free educational content on social media. I educate other investors time over time at meetups as the speaker, right? I actually host one of the largest real estate meetups in Worcester, Massachusetts, which is the second largest city in Massachusetts. I also do a monthly newsletter where I provide free tips and information to investors on all the deals going on, as well as how to be a successful investor, right? So just provide endless value to people, expect nothing in return, right? And then just ask for things very rarely. That's how I raise capital, right? So I'll just provide endless value. And then maybe once in a while, I'll have a deal and I'll send it out to my mailing list. And lo and behold, people actually want to invest with me because I know what I'm doing, right? And I'm providing them value time and time again. I think people tend to forget that this world literally runs on reciprocity, right? And if you just give, people will feel a human need. It's in human nature that they're going to want to give back.
Love it. Now, just to break it down, what we're doing is we're going out and getting debt for 70% of the project while bringing 30% of the down payment, for example. But that 30% down payment is actually coming from other investors. So you're not necessarily fronting that money yourself, correct?
You're absolutely right. It's the whole concept of arbitrage, right? Where you're raising part the whole capital stack. Some of the money's coming from the bank. Some of the money's coming from investors. You're putting the deal together. You're making it profitable, and you're collecting the delta in the form of returns.
Love it. Now, how are you structuring those partnerships from the fundraising? Are you giving them a piece of the equity, or are you giving them some of the cash flow? What does that look like for you?
So there's many different ways to put a deal together. I mean, there's almost an endless amount of ways to put a deal together. Some typical ways that I've seen deals be put together by myself and other investors are pretty much 3 separate ways. Promissory notes, where you're typically raising debt at a fixed rate for a certain period of time. Think an 8, 10, 12% note for a year, right? You raise that money from the investors, use that in the deal, you stabilize the deal, you either sell or refi out, you pay back the investors, you collect the delta. That's a simple way of raising capital, and that's a very easy way for newer investors, right? The more complicated way to raise money from investors is via joint ventures and syndications. So joint ventures is typically a bunch of people create an LLC and they buy it hand in hand together, right? The thing about joint ventures is very important to understand is you have to be an active investor to be part of a joint venture, meaning you have to have some type of role in the property. It could be bookkeeping, it could be managing the tenants, it could be collecting rent, right? But you have to have some role where you're an active participant versus syndications where, there's 2 classes of investors. One is the general partners who are managing the deals and have all of the voting rights typically, and the other partner is a limited partner where they are completely passive. They are more or less just collecting mailbox money, right? And syndications are essentially an SEC exclusion, so they're a lot more complicated, a lot more legal work associated with setting them up. So those are typically the three structures. You raise money via promissory notes, a fixed interest rate. You raise money via joint ventures, where everybody's bringing a piece to the pie. Everybody's doing work in the deal in some capacity. Your work may not be financial, right? Your work could be sweat equity, but everybody's doing work in a nutshell. And then the syndication is you essentially hire a syndication attorney to put together legal paperwork where you're actually, raising money from investors in a passive capacity. It's not a security, but it very much acts like a security. You're actually getting an exclusion from the SEC to use this type of mechanism.
So just to break it down, promissory notes are basically a promise on the money where you're promising a return that's not necessarily tied to the asset, while syndications and joint ventures is you're actually giving a piece of the equity, a piece of the property to your partners. Is that correct?
Yeah, that's absolutely right. You're giving a piece of the up. Yeah. So typically in the joint venture and the syndication model, you might offer what they call a preferred return, where it's the interest on the money in the deal, and you give them equity upside, right? But obviously that interest is going to be way lower than a promissory note, right? So you're talking 6, 7, 8% in equity upside versus a promissory note might be 8, 9, 10, 12%, and you get no equity upside, right? So they're different mechanisms, and obviously the promissory note offers higher returns, but has less upside, and vice versa with the other options.
Cool. Love it. And now we get to the fifth part of this process, which is bringing a deal to the finish line. So we've done our due diligence. We've got partners to promise us the money for the project, and we are ready to form our LLC. Is that correct?
Yeah, so this is the fun part where you're actually putting all the pieces together for this amazing puzzle that will create a ton of wealth for you, right? So the way you do it is you first got to form the LLC, right? And it's very important to actually form the LLC in the state where the asset is located, right? Because a lot of times these states make you pay additional fees to do business in that state. So if you got an LLC in Wyoming, you bought the asset in Wyoming, and then you have to pay the Massachusetts Secretary of State to do business in that state, you're essentially paying two LLC fees. It just doesn't make sense, right? And you can just go into a whole bunch of things regarding jurisdiction and, the fact that you want to have the courts in the state where the property is happening. More or less, just trust me, form the LLC in the state where the asset is based, right? After that, you got to want to create the bank account under that LLC, right? And once you have the bank account set up, you're going to want to sign the operating agreement. If there's an operating agreement, sign the associated promissory notes and collect the funds, put the funds in the operating account. At that point, you're pretty close to bringing this to close, right? Obviously, before you close, you have to ensure you get estoppels showing where the rents are and they substantiate your underwriting and substantiate all the documentation you received thus far, right? Then at that point, you're reviewing the HUD, the settlement statement to ensure everything aligns, the taxes align, the rent, the expected security deposits, last month's, right? And then at that point, you're simply signing, you're closing the property, and you're closing the property, and you're moving on with your stabilization plan.
And that brings us to our conclusion. Once you sign the documents, you can begin the stabilization and onboarding the property management, and the asset's all yours.
That's exactly true, Artem. If you want to see more cool content like this, make sure to follow the Freedom Real Estate Podcast, and we'll give you some really good shit. Okay.
You're wild. Cool. Now, getting back to this North Marlborough multifamily,
Yep.
how would you go about structuring this deal? How much would you want to raise? How much would you want to do in debt? And then talk to me a little bit about the business plan. How would you...
So if you look at the units, they all look pretty dated, right? Mm-hmm. Would you agree?
Absolutely. They could use a refresher.
Sure, they could use a refresher, but they look like they have pretty good cabinets, right? You could probably salvage those cabinets, right?
I would say, what would I want to say? You have to go unit by unit, but some you could raise rents immediately. Some might need a little bit of TLC and touch-up before you get market rents.
Okay, all right. So let's say we're just assuming $10,000 on a per unit basis in renovation, right?
That's fair.
Right, let's just assume that, right? And let's just assume maybe there's, $30K in CapEx, unforeseen CapEx, right? Mm-hmm. All right, so there's 9 units at $10K, that's $90K, plus $30K in unforeseen CapEx. You're talking $120,000, right? So if we mention that, we're trying to buy this thing at the 1.2% rule, all in cost, right? Mm-hmm. So all in cost in this thing is $14,000. Our all in cost based off the monthly rent roll of $14,400 is $1.44 million.
Correct.
Right. So now you got to work your way back to a 1.2% rule, assuming there's 120,000 renovation. So based off the monthly rent roll of 14,400, our all-in cost of $1.44 million essentially would equal a 1% rule, right? So say we're trying to aim for a 1.2% rule. That would equate to our all-in cost in this building equal $1.2 million, right? And if we're at $1.2 million and we had about $120,000 in renovations, we have to minus that from that number, and that would be our offer number, right? And that would typically provide you a 9 to 10% cash on cash return, right? So we can throw that in our underwriting model with all the expenses, which would be, the pro forma rent roll, the taxes, the insurance, the mortgage payment, trash, common electric, landscaping, snow removal, money set aside for CapEx, repair, maintenance, property management, right? And some money is set aside for your annual taxes, right? So that'd be I'd put that in the underwriting, but I'd be surprised, if that property did not produce a 9 or 10% cash on cash return, right? So in this particular example, I'd probably offer around, 1,070,000 or so. 1,150,000. That's probably where I would land with a property like this, just based off back of the napkin math.
Perfect. And how would you want to structure this deal? Would you want promissory notes from investors? Would you want joint venture syndication?
So, it all depends on your confidence in your ability to stabilize the deal, right? If you're taking promissory notes, you have to be in and out of that deal within a year and a half all day, right? But if you're taking, if you're joint venturing or syndications, right, then you could do your business plan slower because the debt is not eating you down because your pref is a lot lower to substantiate, right? Your pref return, right? So, in this particular model, I definitely would do a syndication. To do syndication paperwork alone is $15,000 to $20,000 to pay a syndication attorney. $15,000 to $20,000 in sunk costs on a $1.2 million purchase, a $1.1 million purchase doesn't make sense. It's just too much of a sunk cost on such a small asset.
On top of having to do renovations in the same year.
Exactly. So in this particular scenario, I would either joint venture it or do a promissory note, right? Joint venture is the safer path, which, will allow me, 2 to 3 years of time to stabilize the property. If I want to stabilize it quickly and potentially keep more of the upside, I would I would do promissory notes, but I would also, have more of a dramatic downside if I couldn't kind of, refinance my money out of this particular property.
So you have to buy it low enough to make these numbers make sense.
You absolutely have to buy it low enough where you have the ability to create equity, where you can actually utilize that equity to, grow your portfolio further, for sure.
I would say just in case you have hidden expenses or there's scope creep.
Yeah, you absolutely want to have contingencies in place just in case if there's hidden expenses and scope creep that you didn't anticipate.
Cool. And that is exactly how professional investors like Andrew analyze their deals. And we did a live example just for you guys.
So that was from beginning to end on how we analyze a deal, we offer on a deal, we find debt, raise capital, and bring it to the finish line. So most experienced investors would keep this to themselves, but as you are aware, we love providing value and we love growing together. See you at the next podcast, guys.
Thank you so much.